Hey guys, Ben Nash from Pivot Wealth here, and today I'm really excited to be here with Dr. Mike Kollo. Mike is a quant and the CEO of Clanz, who is a crypto platform recently launched whose mission is to make crypto accessible and investable. Mike, thanks for joining us, mate.
Hi Ben, how are you?
Hey, all good over here. Just watching all of the fear and uncertainty play out in markets, as I'm sure you are as well. And I know that you got a pretty deep background in institutional investments and the crypto space as well. So I'm keen to pick your brain and see what your thoughts are, what people should be thinking about, as well as some of the things that maybe happen behind the scenes that people may not be aware of. Maybe a good place to start is, what's your take on where the crypto market is at today?
Right, okay. So this is a good story, but a big story. So uh, I would sort of start the story a little bit, and I need to give context here. Late last year. So late last year, imagine we're sitting here about 9 months ago, 10 months ago. Crypto's going up a lot. Everything's fantastic. We're all kind of really, really happy with that. The other thing that's happening in the background is that institutions are entering the market. People are trading cryptos as if they were risky assets. So suddenly Bitcoin, Ethereum, all these things start to be correlated with equities rather than commodities. And so it's no longer digital gold. It's no longer anything to do with the price of gold. In fact, it's purely to do with market direction. So people are enthusiastic about tech, for example, tech stocks. So they're buying tech stocks, they're buying cryptos, and these institutional flows are essentially pushing prices. And we see people making a lot of money. There's a lot of FOMO in markets. We're all very happy. Around November, basically the sell-off begins. And from November till probably about a month ago, we're seeing a very steady and stable price decrease across all tech in the US, across cryptos as well. So to think about cryptos in isolation of all of that is to miss the point that they're bigger. They're part of now a much bigger ecosystem. They reached a certain threshold of liquidity. People wanted to get them, so institutions got in. I think at the height they were close to 2 trillion in market cap. They're close to like 1.1 now. And what you saw was Netflix down 75%. Roblox, if you've got children, I've got children, they love it, also down 70%. 43 million active users. So a lot of tech investors lost money through this 6 months. And obviously, if you're in crypto, you would have lost a significant amount as well, not to mention some of the failures that we saw along the way as some of these, let's say, emperor's clothes moments started to happen. As markets receded, suddenly you went, oh, Celsius, you have no liquidity. Sorry, you got to close up. Now you own, $41 billion, and a lot of people are very upset with you. Or you had Lunar or getting basically sniped by the institutional guys, basically through trading mechanisms, unpegging their currency and creating a bunch of flows over there. So you had this kind of a big wind down. You had across tech and across crypto. And probably about a month ago, it got to this point where pessimism, negativity got such an extreme, especially in the earnings space in the US. Their things look terrible. They look absolutely dire, and recessionary fears and negativity and so on, interest rates rising, all these terrible stories. And what you're starting to see in the current earnings season, which is last week, this week, maybe a little bit trickling into next week as well, is you're going to start to see what you've seen so far. This companies coming back with decent numbers, not exceptionally numbers, but decent, but not terrible. And so therefore, companies like Pinterest, for example, Pinterest will do 8% of earnings growth. So everybody goes, oh, that's actually not so bad. And therefore 20% rise in a day. So that's an example of a tech company that is kind of getting ticked up. But there's a whole bunch of others. And as a result, you also start to see the cryptos and other risky assets, which are big leverage plays on tech, essentially. The average sensitivity of a crypto to tech will be or somewhere in the order of 2 to 3, which basically means for every percentage of tech move, you'll expect to see 2 to 3 times that move in crypto land. And you start to see things kind of jumping around a lot. So last week was an enormously positive week for crypto. This week, a little bit less, a little bit more mixed picture, but still some really good positive names. That doesn't mean we're out of the woods yet. So I don't think it's everything's throwing and the spring is here or we should start planting. Yeah. It doesn't mean that. It means that we have to be a lot more discerning. And I think whereas last year we were like, okay, this is red hot fire, just buy anything, it'll go up. I think we're now in a marketplace where we are facing some serious economic uncertainty. We are facing some serious uncertainty to do with inflation, interest rates, and actually how that plays out. little bit of uncertainty of the earnings space as well. And all these things will play into the sentiment around crypto. So it's not directly what cryptos are. After all, they're just a technology. They represent a blockchain technology, or the idea of that blockchain technology. But because they're traded together with equities and other things, that sentiment flows into their prices as well. So it's hard to see them in isolation of the broader market.
Yeah, and I sort of wonder as well, and you might have a better sense than me on this, but maybe it's hard to sort of figure out. But I wonder how much of it is, you mentioned tech and tech share prices and the broader market investors, but I found like we do a lot of work with tech workers, and the tech workers working in technology, they have a sort of a more of an inclination to be interested in and want to pursue investments through digital assets and cryptocurrencies. And then when tech was all kicking off, those people were all printing cash through, getting great salaries, but then their employer share plans and all of the wealth that comes along with that. At the same time, property market's going right up, so equity values are high as well. Whereas now what we're seeing, like tech is getting hammered for people that didn't have a good plan around their employer share scheme. Some of them are getting tax bills that are bigger than the share, like worth more than what the shares are that they own. So they're feeling a bit poorer. Well, value's gone down, and on properties, and then expenses going up, inflation, interest rates, and a little bit more uncertainty in the economy. That I know that this doesn't necessarily hold, but I feel like people see cryptocurrencies and digital assets as a bit more of a nice to have investment. Certainly that's a lot of the message. Like we want people, especially in the early days, like set their foundations first, get some nice boring investments in, minimize your exposure to the more speculative, more risky, high volatility investments. And then when you get to a point where you go, okay, well, I can afford to carve out 5% or 10% to do this, and it doesn't matter. But I wonder how much of it is that people are now feeling a little bit poorer, and therefore they're going, well, actually, maybe I don't want to have that exposure to something that's as volatile as Bitcoin or some other cryptocurrency. Do you think there's anything in that?
I think there's a lot in that, and it's interesting because one of the big things that I'm going to put this under is, so as a quant, I worked a lot in London. I worked a lot institutional desk. We talked a lot about behavioral biases. We talked a lot about how people perceive the world and how different that is. And then we created strategies to take advantage of them, essentially, or take advantage of these type of things. And one of the things is very important is the perception of risk. So if I tell you that something is risky and you've just lost some money last week and maybe you've got laid off or whatever, you will have much less appetite for it. You'll have a much more keen perception of it. You'll be asking me many more questions of it. If I ask you the same question in November last year, you'll again go, risk what risk? Okay, but that's fine. I'm happy to take it. So inherently, there's emotions that get wrapped up into these words like risk taking and what you should or shouldn't do. And in the land of quant, we do a lot of de-emotionalizing of our decisions. So most of the decisions that we take are based upon an algorithm or a model or an ideal, and therefore we try and remove emotions out of it altogether. So that model will think about risk no matter what's happened in the market. It will think about risk no matter if it's made money or lost money. It's a bit like the excuse me, the gambling, like when you're playing poker and they tell you to always have the same strategy and just enact it, dispassionately and so on. Yeah. I think it's the same kind of idea with quant investing and data-led investing. And it's a great discipline to get into because what you see here is exactly what you said. So you have a part of the trading community who is very much coming and going based upon the seasons. So they have extra disposable income. They come in the market, they buy. The first time it drops, they're out. Their risk, their tolerance is very low, or that they lose their jobs, and the tolerance is very low as well. It's interesting what you said about the timing of the risky assets and non-risky assets. Normally in asset allocation circles, you would say that the younger you are, the higher risk assets you should actually have because you've got time. So you have this asset called time, and so you've got 30 years to work it out, essentially. And so other than obviously keeping yourself alive, paying the bills and all that kind of good stuff, if you're going to invest, you should actually have the riskiest portfolio to begin with. So emerging market equities, commodities, anything that has a large expected rate of return, but obviously large volatility over a long time. And when you really look at that and you think, what does that look like? Like if I'm 20 or 25, what should I be buying? Is it utilities or dividend paying companies, or well, they're kind of like your clip the tickets kind of companies, right? They're the ones who are going to be just pushing out the 2% dividend yields or the 2.5%. And especially in times of inflation, you're going to be looking at that going, well, that's negative real rate of growth. So it actually doesn't even boundary. We've been through the last 20 years where inflation has been effectively nothing. And so we've been quite happy to take on bonds and all these kinds of safe assets, thinking they're safe. I can tell you, just from a risk perspective, the least safe asset you should hold right now is a 10-year bond, for example.
Yeah.
Like a 10-year bond will have a 4% rate of return. If your inflation number is anywhere above that, you're guaranteed to lose money in real terms, right? So it's one of those things where you look at this and think, okay, so what is the optimal thing? It doesn't mean crypto, by the way. It just means risky assets. So risky assets, anything that you think has a future, has a growth. I like crypto because I like blockchain. So I'm not necessarily thinking about the volatility and how I can make money short term. I like the fact that it's got long-term tech behind it. I like the fact that it's going to be a tech that's better and it's going to be around for 10, 15 years. So I kind of like the idea of investing in it long term. But then the question becomes, how do you do that? And how do you do that carefully and effectively and have money that you can afford to every now and then lose 60, 70% of? Like it can't be money that you're putting away to buy a house with in this near term. It can be stuff that you want to touch in 5 or 10 years. But if you need money to live or pay bills or, God forsake, if you're financing it through credit cards or something like that, this is not the market or any kind of risky market.
Yeah, I'd say that in any sort of market. But I think for us, and agree that when you've got a long time to, like when you're creating wealth for, decades into the future, that you want to be risk on. It's just that there's a different spectrum of risk. And potentially it's my lack of understanding of digital assets and the markets and how to, fully eliminate a lot of that risk. But shares, property, like growth investments that are going to grow, but ones where that you're not going to have those setbacks that cause you failures, that you have to go back to the start. Like 70% down, that's actually fine as long as you don't sell, because it's only then that you crystallize the loss. But I think with crypto, because it's a thing that's hard to understand, like the ins and outs of it and the market dynamics and the future and what are the factors and all of those things, that I think people are more likely to make those rash decisions, and then they do actually cost themselves money. Whereas the index fund's down by 50%, you say, well, the market's the market. Look outside, no zombie apocalypse. Okay, I'll just keep holding it for another 10 years and I'm going to be making money again. So, but it does make sense. It's just, you just want to do whatever you need to do, in my view, to keep your momentum going. Whether we know that's going to be up and down in the years, but make sure that momentum builds and you don't suffer a full loss, because then you don't have to go do that work again. But it's an interesting take. I think if people can protect themselves from that, then there's a lot of opportunities there. I'm keen though, as an insider, to hear, like you mentioned a couple of the bigger failures, and I would say UST, Luna was probably one of the biggest ones. Well, one of the ones that impacted maybe the most people. What's your take on that whole saga?
Well, there's 2 big failures, I guess, that we can talk about in this context. One is Celsius, one is Luna. They're quite different, right? They're very, very different kind of cases. So Luna was a case of essentially a proof of concept. So what's called a POC. In fact, most of the DeFi protocol, I would say, is still in that stage, where something is built and they say, look, we can do something. We can peg ourselves to a fixed thing called currency, and we can maintain that price really, really well. And the way we're going to do that is by doing some funky financial engineering on either side of it in terms of creating supply and demand differences. However, what happened in this particular case, we believe, and this is not evidence, but this is kind of the word on the street, if you want, is that the way they were going to defend their peg. So normally nobody does pegs, just to be clear. There's like a handful of governments around the world who've got their pegs to their currencies, and they've got massive reserves of oil or gold or something else to defend their peg. Because ultimately you have to defend it if someone's trying to push it out. Famous case being, I think, in 1980s, early 1990s, George Soros pushed the UK pound out of this peg, and it caused massive disruption in the financial economy there. And he made a lot of money, right? Because he's a very famous hedge fund billionaire. In this case, they had a stack of Bitcoin that they were holding to protect this hedge, or to protect this peg. And what happened is, through a series of actions, the counterparty, or the other party, the mysterious institutional investor dash hedge fund dash whoever, pushed them to go and sell the Bitcoin. But the hedge fund partner actually made the money from them selling Bitcoin, because Bitcoin dropped and they were to make money off the futures there. So they were pushing Luna down, and as they were pushing Luna, or the price of Luna down, the Luna owners were selling Bitcoin to try to support it so that they can kind of buy more of it up. And as they were doing that, they were pushing Bitcoin down, so they were making money off that as well. This was purely a predatory action. So it's a little bit, my analogy is like, I don't know, having a little Bambi that you're like stroking, and you're like so happy that you've got this Bambi, and you release into the forest, and you're like, come on, Bambi, go play with the other animals. It's going to be fun. And it's that's what happens when you release into capital markets, right? It's a bunch of predators out there, and anything that's weak will get pushed around, any pegs will get broken. It's a trial by fire. Like, the capital markets is not a nice place. It's a place where people try to make money from other people. And so I think it's and that's some of its power and its strength and its truth comes from the fact that whatever survives is truly worthy of survival. And so I think with Luna, it was a bit experimentary. What were the red flags if you're looking at this beforehand? To be honest with you, one of the biggest red flags was some of the stuff they were doing with staking. So if you were staking your coin, your stable coin, which was pegged to the US dollar, you would receive like 19% rate of return. In fact, I think there was even a fund that was going to come to market in Australia promising off the back of that type of thing. But again, people just took that at face value. They said, "Oh, you're great. You're probably very smart. You're a financial wizard. You can do 19%. You got this." And the last time we saw that, of course, was in the 1990s with long-term capital management, US Fail, which is one of the biggest hedge funds, biggest quant hedge funds. And the difference there was that instead of having a room full of software developers, you had a room full of physicists going, "Yeah, we've done that. We've done the maths. We're good. We got this." And so that crashed. And then for, I don't know, 5 years, nobody said the word quant because it was a dirty word. And then it kind of came back again. So again, if something looks too good to be true in capital markets, it is. Like 19%, you are taking massive amount of counterparty risk and credit risk. If you're receiving 19% in a market where interest rates are 3%, where a AAA corporate is borrowing at, I don't know, 5%, at a D-rate corporate is borrowing at 7%, who's borrowing at 19%? Like, there's somebody's paying you, right?
Yeah.
And so on the other side of that, you have to make up a crazy story. And I heard them all about exchanges needing money, about, I don't know, offshore money needing places to go and borrow, and all these kinds of different stories. But you're a bit like, look, you're just being opportunistic. You're just hoping against all hope that, you can get this 20% if you're staying for a year. It's not even a quick win. I mean, if you're staying for a year, what are you getting? Like, let's say 1.5% a month. So you're getting, I don't know, 32 basis points a week. So every week when you're sitting there lending this money, waiting for the 32 basis points to come in, you're just hoping that the other person is still paying 26%. Like, it's crazy. Like, you're looking at this thing going, no, that's a bit silly. And so look, it would have been very hard to see how this peg would be unlodged. And I think pegs are dangerous no matter what you do. So any stable coin you look at, you have to think about what the strength of the peg is and who's actually going to support it if it gets pushed around. But I think in this particular case, the peg was particularly vulnerable. So kind of pushed over. Again, very different story to Celsius, right? Celsius, 1.5 million customers gone, $41 billion owed. Digital bank failure, very typical, might as well been out of the 1920s when the bank runs in the US. A bank that said, "Hey, I'll give you 7% on your deposits," and they took your money and they gave it to a hedge fund, and the hedge fund makes, I don't know, hopefully 25, 30%, and there's your cut. So the bank is happy. Highly oversimplified, a very complex business plan, but there's this risk transformation, what's called a risk transformation, that happens. And of course, it works fine if markets are going up and your hedge funds are doing really well, or your prop trading desk is doing really well. As soon as it's not, you can no longer pay that deposit because you're no longer in the means to do so. So you're either paying it from other people's deposits, so the Ponzi scheme element begins, or you're just saying, "Look, sorry, oops, actually that was an investment. It wasn't a deposit." Just to be clear, it was uncertain outcome. And I used to work at BlackRock. We used to have a set of funds called Target Return Fund, and their job was to achieve 5 or 7% rate of return. They had to be rebranded after 2008 to Target Risk Funds because we couldn't guarantee, you couldn't even apply a rate of return with riskiness, right? You just couldn't do it.
Yeah.
Very different.
And I think just to qualify one of the things you said there, you said people know that you can't get that much. It's that people should know that, because I think there's a lot of people that don't. And I get money's confusing. Excuse me. There's so many parts to it, but I was just sharing with you before we fired up the recording that, like, I was getting comments on my TikTok and people are going, what's the risk of this? And they've got all this money in UST thinking that they're going to get 20% return. And it's like, well, you're like doubling a bit the return, the risk of the share market, at least. Like, that's what the return should tell you, that we know that the long-term cash return is probably, 3% or something. The long-term return on the market is about 9. If you're looking at a cash investment, like you say, Celsius deposits, and they're saying 7, it's not cash. No one's giving you 7 on cash, because no one can get 7 on cash. So that means there's risk. If they're saying 20%, you know that there's some serious risk that would need to be taken to get there. And that's hopefully a lesson for people in there. But for me, when it comes, and it's like there's a lot of different ways to be right, and obviously the quant game, if you're an institutional investor, it is a different world when it comes to how to make money. But for people, when it comes to building wealth, I think like the blue chip, more stable investments that have high growth potential but lower risk, have that consistency. If you're getting 9% year on year, it's like $53 a week is going to make you a millionaire in 30 years. So yeah, it's great if you can get 15%, that's going to be great, and it's going to get you there faster. But 15% or 0% or negative 100%, I suppose, is a challenging proposition. And you got to think how much risk you actually need to get where you want to be. Mike, you've mentioned a few things there already, but like as an investor, as an individual investor, and as a professional investor, what have been some of the biggest lessons that you've learned?
Oh, gee whiz. I think if you've been in markets long enough, you've been humbled, right? So, and I've been humbled a lot.
That's a nice way of putting it. I like that.
Yeah. So I think, look, I began my career in 2007. So talk about getting humbled, right? Young PhD, coming out of my degree, I was like, yeah, I'm going to do this. Join BlackRock, woohoo! And then 2008, and you're like, oh, that's bad. And I remember sitting there back in 2008, just there was an existentialist question, like, is there going to be a financial system? The Economist was writing about how capitalism is better than communism. Like, that's the level of dire straits that we're in at the time. There was a lot of questions being asked. Look, so for me, I think one of the things I've learned, and as a quant, as somebody who pays a lot of attention to data, is the thin line of predictive power that the entire industry of financial services has. So when let's say an investor, a analyst, somebody you watch on Bloomberg, CNBC, or listen to me or whoever, when they say something about the future, aka this stock is going up or going down, on average, the probability of success of that being true for a great manager is about 52%. Probably being wrong is 48%. Just to
For a
set this
great
up,
manager.
a monkey is a 50-50. So we're talking about a very thin line, right? That's a very, very thin line.
Yeah.
And people who look at the data understand that this is a very thin line, understand that we're eking out 1% more accuracy by doing all this work and background research and degrees and everything you want to ever say. There's no such thing as certainty. If anybody says it will definitely do this, this is definitely what's happening, it's at 52%. And we forget that because the language that we use has this certainty bias embedded in it. Like, nobody goes to, for example, at the TV show and says, I'm not really sure what's going to happen in the future. I think these are kind of two competing ideas, maybe something. They say they talk about the thesis. They make it seem very uncertain. There's a wonderful book that outlines this really beautifully called Super Forecasting. It's a famous book that it was once New York bestseller, and it talks a lot about what does it make to be a good forecaster. And it makes exactly this point that they did this massive study where they studied professionals and amateurs betting on financial markets, or kind of forecasting financial markets. And they found that professionals and amateurs were about the same. So as individuals, they were not different to each other. But what they found is that the people who were consistently better forecasters, aka this 52, 53%, were people who were constantly looking at the world, constantly evaluating, constantly uncertain, constantly updating their probabilities. and they were not the people who stand in front of televisions and say, I know what the future is. Because that funneling of uncertainty into, I'm definitely sure that something's going to happen, basically made them miss a lot of that things that were going on around them. So I think it's a common bias we all have, which is we like stories, like we like narratives. And so when we look back on something, it's neat to fit a story to it. Like I just did at the beginning of this podcast. I just went, oh yeah, November to now, that's the story. And you're like, oh, that's nice. But I've really just looked through a keyhole and given you a story, and it kind of feels okay. The reality is that there was so much more complexity about what happened late last year and early this year, from the Ukraine war and all these other things that were happening that we didn't know how it was going to turn out. And I think when you think about forecasting and looking to the future, even when you're thinking about it in blue chip terms and stable terms, so you're kind of making also an assessment of that future. So when you say something is blue chip or stable, you're saying it will be stable or it will be blue chip, not just it has been. And therefore, what you're really doing there is creating some kind of forecast. Maybe it's a very reasonable forecast because you're like, well, it's not going anywhere, it's a building, but you are creating some kind of forecast. So being very careful about your assumptions of your forecast. Is that really true in the current interest rate environment and inflation? If you want to make positive real rates of return, should you be thinking about blue chip stable assets that give you 3%, right? Maybe not in this environment, maybe in other environments, yes. So it's more about the way you think about it. I would say that's one of my biggest lessons about both going through the PhD program and then later on in financial markets in London for about 15 years, is what separates let's say good to great investors or products and advice is that structure of thinking. Is that really going back to questioning, saying, what do I know about the future? What do I think is possible? In that scenario, what do I think is probably going to happen? And therefore, so a little bit of scenario analysis, a little bit of that humility that comes into saying, okay, the future is very, very hard to know.
So when you say that nobody knows, does that mean that the 143 people that commented on my most recent TikTok saying that interest rates definitely aren't going to decrease until at least 2027, do you mean that they're not certain about that? Because they sounded incredibly certain.
Yes, I believe that they are very certain. It's a very interesting thing, right? If you recall just about any strategist, and apologies to my entire industry for saying this, but recall any equity strategist or market strategist, anybody you listen to, and say to them, how often do they talk about the accuracy of their models? So with Quant, we religiously track the accuracy of our models. We have to constantly see if we're achieving that 52%. If we're not, we change. It's interesting to see that none of the rest of the industry does. So nobody turns up at an interview or whatever saying, well, out of the last 100 calls I made, I kind of got most of them wrong, or I kind of got 50-50, or nobody does that. The rigor of self-assessment, learning, development isn't there. So if you're really thinking about investing and you're thinking about that you have an edge, or you have an interesting insight, put yourself into that test where you write down essentially your bets or the trades that you put on, the beliefs that you have. You don't have to trade on them, the beliefs that you have. Write down something around an actual forecast date, like 3 months from now, I think the markets will be up 10%. 2 months from now, I expect this to happen, etc. Even if you're not trading on it, and just re-examine it as a little mental test in 3 months. And maybe you write down the reasons why you might think. And often what you find is when you re-examine that, you think, wow, those reasons I thought were really important 3 months ago, the news cycle changed, and now I'm thinking about completely different things. Those outcomes that happened, maybe not, maybe like we might have 50-50, might have 60-40, etc. It takes a lot of rigor for you to continue to follow the same thread of forecasting capability. So I'm only guessing that there's 100 and therefore about 25 odd bots that commented on your TikTok, according to Elon Musk, about 25%, are probably not going through that type of rigor.
I think you might be onto something there, but I think that being serious, the lesson there is just knowing that you can and will be wrong. I think is a big part of it, and questioning all of those assumptions, what could go wrong. And I think when people don't do that, they not only making bad decisions, but you get the wrong confidence. And I don't need to tell you, but like you say, all of those biases, and something goes right and we think that we're the hero, something goes wrong and it's someone else's fault. And all of these things, I think if you realize that we're flawed and you realize that you're probably, not as good a guesser as you think, then it probably sets the right tone for making some of the decisions. On that, and obviously in the current environment with inflation up, interest rates coming up, 2 quarters negative growth in the US, here slowing down as well. Risk is something that's more front of mind. Maybe still not as front of mind as it should be, but more front of mind than it was. So, how do you think people should be thinking of risk in the current environment?
Gee whiz, it's a big topic. I mean, risk is a massive, massive topic for anybody. I mean, the question is largely about horizon. So one of the things that we often don't talk when we talk about these things is horizon. So innately, your question, I think, talks about recent market developments. So it's probably thinking a couple of quarters ahead. If you're thinking about 10 years ahead, the question is very different. If you think about 20 years ahead, life savings, the question is different again. If you think about the immediate, let's say 6 months, and what are the chances? Again, I think if you look at financial markets, the financial press, the current consensus is that companies are having trouble doing business. Many kinds of companies, not all industries. They're having problems finding staff. They're having problems with supply chains. I was in a recent, as anecdotal evidence, I was in a recent a shop here, a photography shop, and they had to close down the entire bottom floor because they didn't have enough staff. So that's approximately half your revenue gone, for that day or that week. So there's a lot of these types of glitches in the economy, I would say, as we start to get moving post-COVID, as we start to work through things like China dependency on supply chains and various things like that. So I think there's a lot of scope there, and I'm hearing again stories from that to start to filter into uncertainty, consumption, and so on. So there is no way that you can raise interest rates by as much as the US wants to, so take it up to 3.4, and that people are going to have as much disposable income. So they have to have lower disposable income. They have to have all these things. The question is whether it's already in prices, and so to what extent. So as I mentioned before, recently markets actually jumped on news that things were okay. Like they didn't jump on the fact that things were great. So whenever you're thinking about this, there's two conversations maybe you want to have. One is, what's my view? Do I think it's going to be bad or worse or whatever? How much of it am I biased by my circumstances versus what I'm reading? The second question is, what's already in prices? Because if prices are already reflecting a doom and gloom scenario, all it has to be is just bad, and you get a jump in prices. And so that mismatch between expectations and reality is often forgotten by people because they look at, let's say, for example, the world, and they say, I'm really upset with this world. I think we're having terrible geopolitical problems and wars and whatever. Therefore, I'm unhappy. But if it's already in prices, you can still have rallies. So I think my sense is that people are quite that the markets are pretty pessimistic, and I don't think it's going to be as bad as that. So I think we will probably see interest rates take effect for the wrong reasons. We'll probably see inflation come down, and we're seeing oil come down as well a little bit now. So that probably will work. But even if it doesn't work, keep in mind that every time that we've had a significant problem in the economy, the central banks have come in and lowered rates. So again, if we trip and fall here, you'd expect as a kind of a game theoretic model for the central banks to come in. They're not going to stand on the side and go, sorry guys, I've been helping you all along now, but now that you've got inflation, I can't do anything.
Yeah.
No, they're probably going to step in and help out in some way or another, or the government certainly are going to as well. So we live in I think we live in a managed economy. So therefore, the concept of risk in the short term is not capital markets risk, aka cryptos. You lose 70%, just what it is. There's no one going to protect you. Yeah, I think we live in a much more kind of managed kind of world. So I'm cautiously optimistic. I think it's going to be bumpy. I think the labor markets, lack of skill shortages will be holding back companies from innovating and changing and moving the way they want to. I think a lot of these problems will actually occur within certain industries. At an aggregate level, it might just wash out a little bit. Again, tech companies should do better in these environments. They have more pricing power. They're able to not take commodity prices at face value. They're able to distribute pretty easily. If you're thinking about 5 or 10 years ahead, again, I think Australia is in a pretty good position for all the usual reasons, right? Great commodities, rare earths. If they're able to reroute some of the supply chains between China and other countries and keep that very flexible, not be too focused, I think that'd be very good. I think there's a very strong awareness that nobody wants inflation to stick around. So it's coming this year. But I would be very surprised if there's significant inflation in a year from now, for example. Like I think so many people are focused on getting prices down and making sure that kind of works. So and again, I don't really believe in that disaster scenario, or I think it's an outside probability. And never say never, but I mean, just said what I said. But I think it's a low probability. So my sense is that I'm cautiously optimistic. I think for every dollar lost in the high-end property market is a dollar that a new owner can get in quicker, or that you can have more entry into the property market. So it's really just a transfer of wealth game that we're talking about. I don't think we're talking about an aggregate fall in wealth or bad situation, especially in the medium to longer term.
Absolutely. It's like that thing that time tends to de-risk all risk in a lot of cases. And I think picking, anything in the best of times challenging, but trying to do it with a short-term horizon even more so. Mike, thank you so much for sharing your insights there. I could keep talking about this all day, and maybe we'll have to get you back another time so we can do just that. But my last question for you for today is, if you could go back to your bright-eyed, bushy-tailed self when you were first entering into investment markets and give yourself one piece of advice, what would it be, other than put it all into Bitcoin?
I have a saying for this that I quite like, which I think has always been the saying I've probably wanted to keep to, which is, the race is long, and in the end, it's only with yourself. And this sense that, experiences come and go, markets come and go. What stays with you are essentially your life story, right? Who you were, the people you met, how you went through it. So for me, being in London, being in an excellent institutions, ironically, I don't remember the risk numbers. I don't remember the percentages. I remember the feeling. I remember the people. And I suppose it's hard to say that to a young man, right? Because you're out there to conquer the world. You're out there to dominate and to win. That's what you want to do. But ultimately, I think I've had the chance to teach, for example, at university, at Imperial College. I was teaching for a number of years while I was working in the industry. And I suppose trying to urge myself, a young version of myself, to just be patient and to be in the moment, right? Not let the moments of life just flow away from you in conquest of a larger goal of wealth or something that you think you want at that time. But just to be in those moments and to really experience them and meet the people and so on, I think is really the calligraphy of your life, right? It's the beautiful shape that it takes, and that ultimately you can pass on to other people and so on. So I sound like a really old man. I'm not that old. I'm really old. But it's a funny thing. Even I've had a few stages in my life, a few kind of career changes and things like that. It's always very interesting to reflect.
It's not the answer I expected from a quant. I thought you'd say, like, learn the if function faster, or something like that.
Exactly. I was going to say, yeah, invest in Amazon, learn Python, and you can optimize the skills. So yeah, exactly.
Awesome, mate. No, some very wise advice there. Mike, thank you so much. Really appreciate you sharing your insights, mate. I look forward to the next one.
All right. Thanks, Ben.
Cheers, guys. We'll catch you next